So I suspect oil is telling you something about the economy. Gold's telling you something about the financial system, that we're getting close to some sort of new financial system where gold might be part of a new system. And also gold could be anticipating, like I said earlier, a huge amount of quantitative easing and money printing in a recession. Right now, we're not doing QE. Gold may be anticipating QE coming back quick. So just, there could be, if this turns into a credit event, a systemic problem, which we're not calling yet, gold could take a nice hit, but it will, recover and go back to all-time highs. But, gold is not the perfect hedge if there's a systemic.
The U.S. economy entered 2025 with solid momentum, but GDP growth in the first quarter appears to be weakening. Actual consumer spending declined in January, though some of the softness may be due to adverse weather conditions. Rising uncertainty around tariffs and federal government job cuts, coupled with signs of slowing growth, has increased the risk of an economic downturn. However, this is not the base case scenario, as the economy's underlying fundamentals remain generally strong. Ed Dowd, however, sees troubling signs, suggesting the economy may be heading in the wrong direction. He believes we are on the verge of a deflationary scare, an impending correction in the stock and asset markets. The most significant uncertainty, in his view, is how policymakers will respond. Dowd expects the Federal Reserve and the government to intervene with monetary and fiscal stimulus to counteract a recession. The S&P 500 has entered its first correction since October 2023, dropping 10% from its recent highs. Meanwhile, gold has surged past $3,000 per ounce for the first time, reflecting investor anxiety. Historically, gold has thrived in uncertain times. When markets correct, inflation concerns linger, and geopolitical risks escalate, it tends to outperform. Central banks are accumulating gold unprecedentedly, signaling their confidence in it as a store of value amid financial instability. According to Dowd, gold reflects stress in the financial system and could be anticipating a transition toward a new economic framework, one in which it plays a key role. If the current situation escalates into a significant credit event, something he isn't calling just yet, gold could experience a sharp sell-off before rebounding to new all-time highs. For those bracing for such a crisis, Dowd suggests that cash, particularly short-term treasury bills, may serve as a more reliable short-term hedge than gold. We're about to explore the video, but first, subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
Well, gold goes up and down for a variety of different reasons. And if you look at commodities, the commodities basket, the CRB, it peaked in June of 2022. And it came down into 2023. It's been going sideways. And the price of oil is indicating economic activity may be going the wrong way because, with all this geopolitical tension, oil should be spiking. So I suspect oil is telling you something about the economy. Gold's telling you something about the financial system, that we're getting close to some sort of new financial system where gold might be part of a new system. And also gold could be anticipating, like I said earlier, a huge amount of quantitative easing and money printing in a recession. Right now, we're not doing QE. Gold may be anticipating QE coming back quick.
Which would be inflationary, of course, right?
So our call is this. We're going to see a deflationary scare, which is a correction in the stock market, the asset markets, but we don't know what the policy response is going to be. And the policy response is going to be the Federal Reserve and fiscal spend to take us out of the recession. Once we see those, we suspect we're going to have an inflationary problem again. So we're going to have this roller coaster of deflation, inflation. We're kind of at the end of this system. The system is just so rife with too much sovereign debt, that you can't raise interest rates for too long to fight inflation without having a deflationary scare, which is what we're getting. And the only reason we didn't get it earlier is because of the government spending that we did the last 2 years. But we're close to the aha moment, the deflation scare, and then the massive policy response, which at that time will flip bullish and talk about inflation.
How do they respond?
Bullish on risk assets, but obviously the middle America won't like it
As well.
not right away. You got to remember, monetary policy has an 18-month lag. When we did the COVID printing in 2020, About 18 months later, that's when inflation inflected and took off. So it takes time for the mechanism to work. So first we get the pain, then we get the inflation, and gold. The one thing to say about gold, in the 2008 great financial crisis, gold was on a bull run from 2002 into 2008, massive bull run. And then gold corrected 50% because there was a credit event. There was a systemic credit event called Lehman. So gold went down 50% because people had margin calls and they sold what they could, not what they wanted to. So just, there could be, if this turns into a credit event, a systemic problem, which we're not calling yet, gold could take a nice hit, but it will, recover and go back to all-time highs. But, gold is not the perfect hedge if there's a systemic, credit crisis.
What would be a better hedge?
Cash, if you're predicting that. Warren Buffett is, I'm sure he owns some gold, but Warren Buffett's got $390 billion of 3-month T-bills.
Recent economic data presents a mixed picture. According to the University of Michigan, consumer confidence has fallen to its lowest level since November 2022. While retail sales have slowed, construction spending has dipped, and manufacturing activity has declined. Despite these warning signs, the labor market remains resilient, with historically low unemployment and rising wages. Some economists believe a recession is imminent. The Atlanta Fed's GDP Now model projects a 2.4% contraction in the U.S. economy for the first quarter, while PIMCO has raised its recession probability for 2025 to 35%, up from 15% in December. However, FactSet data shows fewer S&P 500 companies have mentioned recession in earnings calls than ever since early 2018. Ed Dowd identifies gold as a key indicator of monetary policy expectations. He believes the gold market forecasts an impending recession and a substantial expansion of U.S. deficits. According to Dowd, deficit spending will inevitably increase, especially if the stock market declines, given that approximately 25% of total tax revenue comes from capital gains. Now let's redirect our attention to a video.
I think our thesis is coming to fruition quicker than we thought, and our thesis is pretty simple. We made a call in 2023, spring of 23, that we were predicting, according to our early cycle indicators, very quantitative, high-level work, that a recession was coming in 23, beginning in 24. We were wrong, and so were a lot of other hosts of economists as well. We asked ourselves, why were we wrong? Have the fundamental laws of economics changed, or are we missing something? So we reverse engineered why we were wrong. And what we discovered was unprecedented fiscal dominance, a little bit of statistical tomfoolery in the non-farm payrolls, and unprecedented government spending. And if you look at the last 2 years of the Biden administration, we were running 8% of GDP deficits, which are crisis level deficits. In the great financial crisis, we were briefly at 10%. So you had to ask yourself, what was the crisis? Well, the crisis was to keep the economy afloat into the election, and also fund what we've discovered, the elephant in the room, illegal immigration. We have 10 million border encounters, so we know of 10 million that came in over the last 4 years. It's likely 15 to 20, but let's stick with 10. Normal net legal migration is 1 million a year. So this really distorted the economy. And in our report, we detail how it held up the housing market to a certain extent. And all this is going to reverse under Trump. And the government jobs added were a big part of the payroll growth. And all that is reversing out. And it wasn't sustainable anyways, because the debt was growing too fast. And they needed to continually increase the amount of spending to keep this whole thing from falling apart. And the reason why we're surprised, it's happening quicker than we thought. When Trump got elected, we already heard stories about self-deportations, but we think it's already an indication that we're going to see inflation starting to come down. When you bring in 10 to 20 million people and give them money, they tend to spend it immediately in the economy. And we've calculated back of the envelope math that if you bring in, let's just say 10 million, what's the economic all-in cost of bringing that person from Central America in? So you have to give them money through an NGO to get them from Central America to the Darien Gap, through the Darien Gap to the Mexican border, then over. Then you need to transport them somewhere within the U.S. because they all didn't just hang out at the southern border; they were put everywhere. Then you give them accommodations, then you give them food and clothing and money. So you could say, realistically, the all-in economic cost for one illegal immigrant was anywhere from $50,000 to $100,000, including all the NGO spend. And so that stimulated the economy anywhere from $500 billion to $1.5 trillion, which was funded through debt, U.S. Treasury debt, our tax dollars. So that's all unwinding. That's the big elephant in the room that really supported GDP growth along with government jobs. And the real economy has been struggling. That's why Trump was elected. It was minus 2% real wage growth going into the election. 1980, Ronald Reagan had the same thing, landslide. Bill Clinton had the same statistic, and he won. So the real economy has been weak, and that's why we made the call that it was going into recession, because traditional measures like PMI and a whole host of other indicators were pointing down. Well, if gold is a proxy for money printing, and what the gold market's anticipating is a recession.
Tariffs have proven to be a boon for gold investors, as trade policy uncertainty and recession fears drive demand for safe haven assets. A prolonged surge in central bank gold purchases has fueled the metal's rally, rewarding traders who have long bet on its resilience. While massive government spending and fiscal dominance have temporarily propped up the economy, their eventual unwinding increases the risk of a downturn. With widening deficits and potential stock market declines threatening tax revenues, policymakers may resort to monetary and fiscal intervention. Gold's strength reflects market expectations of such measures, solidifying its role as a hedge against economic uncertainty. What's next? With gold surging and rising recession risks, what is the next big move in the markets? Share your feedback in the comments below. If you found this helpful video, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.